Have you ever wondered whether investing in individual stocks is better than index funds? Well, you're not alone. This is a question that has intrigued many a mind, and today we're about to delve into it. Let's start with the basics. Individual stocks are essentially a share of a company. When you buy a stock, you're buying a piece of that business. On the other hand, an index fund is a type of mutual fund or exchange-traded fund with a portfolio constructed to match or track the components of a financial market index. Both of these investment avenues have their unique characteristics and potential for returns. However, they also come with their own sets of risks and challenges. This video aims to help you understand these aspects, laying out the pros and cons of both individual stocks and index funds. So, buckle up as we delve into the world of investing and explore the differences between individual stocks and index funds. So, what makes investing in individual stocks appealing, and what are the potential downsides? Let's start with the upside. One of the biggest attractions of individual stocks is the potential for higher returns. If you've ever heard stories of people making fortunes from investing in a hot tech startup or an old company that suddenly took off, those are examples of the kind of high returns that individual stocks can deliver. In addition, investing in individual stocks gives you the ability to choose specific companies. If you believe in the future of electric cars, for example, you might want to invest in a company that's leading in that field. This allows you to align your investments with your beliefs and preferences and potentially profit from your insights. Now let's talk about the flip side. One of the biggest drawbacks of investing in individual stocks is the high risk. Stocks can be volatile, and the price of an individual stock can fluctuate wildly based on a wide range of factors. Even experienced investors can't predict these movements accurately all the time. Investing in individual stocks also requires a lot of research and financial knowledge. You need to understand the company's business model, its financial health, its competitive position, and many other factors. This can be time-consuming and challenging, especially if you're new to investing. In addition, individual stocks can be more volatile than index funds. If a company faces a scandal, a lawsuit, or a disappointing earnings report, its stock price can plummet overnight. On the other hand, an index fund, which holds a diversified portfolio of stocks, can spread out this risk. In conclusion, while individual stocks can offer high returns, they come with a fair share of risks and require a good deal of knowledge and research. They can be a rewarding part of your investment portfolio, but they're not for the faint-hearted. It's crucial to do your homework, understand the risks, and be prepared for some ups and downs along the way. Now, how about index funds? What are their strengths and weaknesses? Well, let's start with the positives. One of the main advantages of index funds is diversification. You see, when you invest in an index fund, you're essentially buying a small piece of each company in that index. This means you're spreading your risk across a broad range of companies, rather than putting all your eggs in one basket. Another benefit is the lower risk associated with index funds. Because they're tied to the performance of a whole index, they're less susceptible to the ups and downs of individual companies. So if one company in your index fund tanks, it's unlikely to have a significant impact on your overall investment. Then there's the ease of management. With an index fund, you're basically setting it and forgetting it. You don't need to constantly monitor individual stocks or make time-consuming decisions about when to buy or sell, but it's not all sunshine and roses. One downside to index funds is the potential for lower returns. Because you're diversifying your investment, you're less likely to hit the jackpot with a high-performing stock. Another con is the lack of control. With an index fund, you don't get to pick and choose which companies you invest in. You're at the mercy of the index, for better or worse. Index funds offer a safer, more hands-off approach to investing, but they may not yield as high returns as individual stocks. So, which is the better investment option, individual stocks or index funds? We've delved into the pros and cons of both options, and the conclusion is clear. It all boils down to your personal circumstances. If you're someone who relishes risk and has a deep understanding of the market, individual stocks could be your game. On the other hand, if you favor a more conservative approach with steady returns, index funds might be your cup of tea. Remember, there's no one-size-fits-all answer. The best investment strategy is the one that aligns with your financial goals and risk tolerance. Happy investing!